I'm going to walk you through what we usually refer to as value relevance models. The data will be similar to what we've seen before, but it's a new data set, and the models and functions and packages that we're going to use we've seen before. So there won't be a lot of new material, but I am going to use a few things in different ways that we'll go through. So this is the new data set. I've called it valuation data. And if we look at what that data looks like, it's going to look fairly similar to some other things we've seen. So we have company information that we've seen before. MVE is the market value of equity. So this is the market price at the end of the fiscal year. So on this data date, this was the price for the company, and this is in millions of dollars. So this company was 25 million at that point. Then these other ones are also in millions of dollars, but they are income statement and balance sheet items. So this first one is the accounting common equity value. So this is what the accounting says the book value of the common equity should be. Then we have income statement items, revenues, cost of goods sold, other expenses, and this O&I is other non-operating income. NI is net income. Then we have assets here, so the TA is total assets. Then we have current assets, PP&E, other non-current assets, and then we have liabilities. So current liabilities, the liabilities that are long-term debt liabilities, other non-current liabilities, and then the final thing is the number of shares outstanding. So here we have the data set. The thing we are interested in explaining is this market value of equity based on all of this accounting information. So we're trying to see how does this accounting information explain the price that the stock is selling for. So the first one we do is a simple regression. This is market value of equity on, this is the common shareholder equity in the accounting balance sheet and net income. And we're doing this with just reading in the data, so we haven't scaled it, we haven't taken out outliers, anything like that. And we look and see for these regressions, the R-squareds are a little higher, so this is a 55% R-squared. So it does a pretty good job. This is mainly because the variables we're using to explain market value are all related to these ones are bigger, so this one is bigger. So the higher squared comes from just companies being bigger, having everything bigger. And so this creates a few issues in that if we want to explain reasons why companies are valued more, we don't really have that other than sort of this size issue. What can we do to interpret here? Well, here we have the coefficient on book value of equity is near 1. So that means in general, if you have $1 more of equity in your accounting income statement, in your accounting balance sheet, you have $1 more of equity in the value in the stock market. Net income has a coefficient around 8 or 9. So it says for $1 of net income, you have about $9 of value in the stock market. So they're positively correlated. Then we will remove outliers. I've created a new function, but it's basically the same as the outlier function. The only difference here is that if the variable is less than the first percentile, I set it to missing. If it's greater than the 99th percentile, I set it to missing. So this is called trimming the variable. So instead of taking extreme values and moving them in a little bit, what it's doing is removing those extreme values from the data set. So that changes a couple of things we need to do, but for the most part, it's the same as you've seen before. So down here, I'm going to remove outliers by year, and applying this trim function means some of them are going to be missing. So I'm applying it to all of the ones that I'm using in these regressions, and then I'm removing missing values. So what that will do is reduce the number of observations because it's going to take out the bottom and top percent on each side of the distribution. So we run this and you see temp 2 is a little bit smaller than temp. That's because these outliers have been removed. Run the regression, same regression, just the different data set. Notice it's fairly close. The coefficients get a little bit bigger. The R squared's a little stronger, so now we're at 68%. Still around 1 for book value of equity, and still around 9 for net income. So it hasn't affected anything too much, but it's a concern when we're dealing with a bunch of this data, especially when some of the companies are really, really small and then others are enormous. So there can be quite a difference. So one of the things that research has done is tried to say, well, let's make them comparable sizes, and then we can do these regressions, and the results won't be biased by having a bigger size company. So they've tried a bunch of things. The one that seems to work the best is scaling by the number of shares outstanding. So when you hear in the in the newspaper talking about stocks, often it will talk about earnings per share or book value per share. What they're doing is divided by the number of shares that are outstanding. So we're going to do the same thing. Once we divide by this, we can get some really extreme values, so we're going to remove extremes again. And then we'll run the same regression. So I just want you to see sort of how each of these steps makes a difference. So what happens now is the book value of equity is still around 1, and the coefficient on net income is a little smaller. So those do change based on if we scale them or not. Whether that is caused by some sort of bias in the coefficients because we haven't dealt with size, who knows. But I think the important point is they all sort of give similar answers. So the big question is, what does this matter? So we've got these R squareds, and what it's trying to say is the accounting variables can explain a large amount of the value that is represented in the stock price. And it should be, that should happen, right? So if the price were to deviate too much from the actual fundamental value, we have some sort of disconnect, something going wrong. And others have used it to say, and we also get something meaningful that comes out of the accounting information, like the accounting information is reflecting to a large extent what investors care about when they're setting prices. So for the other regressions here, I'm going to do the same thing. I'm just going to use the unscaled version, so I'm not dividing by common shares outstanding, and I'm going to remove the outliers. You could have chose any one of these options, right? So the unscaled here, or trim the unscaled, or scale them and trim them, or scale them and Windsorize them like we did before. Any of those seem to give sort of similar answers, so I'm just going to choose one here, and then we'll go forward with the other tests that we're going to use. We have these packages we've introduced before, and the reason we use them is because it helps us simplify collecting results from regressions and some other things as well. So we did this one before. This tidy function, what it does is put the results of the regressions into a format, a data frame that we can use and apply those. And so we have to tell it to do that and then put it into that format. And then this is just the same, the regression we already did. So if we go and look at that, notice it gives us each year. So I ran it by year, right? It's grouped by year. So running by year, we get the coefficient on book value of equity, the coefficient on net income, and the intercept, and we have that all the way down. So we can then look at what's happening over time, and that's supposed to give us some information about what's happening in the market or what's happening with accounting. So when I run this, so I'm only going to keep the coefficient on book value of equity and net income, and I'm going to plot those. And we've seen this plot before, so same sort of functions. So what do we have that happens here? Well, the coefficient on book value of equity, notice it's gone up a little bit up until 2000, kind of declined again, but it, overall it sort of stayed around this one level. Well, that's good. That's sort of saying that accounting, the balance sheet in accounting, more or less reflects the value of the stock without being biased one way or another. But we do have a couple of interesting things that happen. So as we get further and further towards 2000, there's a growing trend on that. So there's more value, right? So for here, let's say, for example, a $1 change in the book value of your accounting leads to a $1 change in the book value or the market value of your stock. Well, here it's twice that. So it's about $1 change in your book value of accounting, $2 change in your value of your stock, and then it kind of goes down again and changes a little bit. So there are a bunch of reasons for that. I don't know that any are really compelling, but they, people have wondered why that might be the case. So as we're getting closer to 2000, one of the reasons they talk about is that the stock price was getting overheated, like it was overvaluing companies, and we had the crash after the dot-com bubble, and so we'll talk about the income one in just a minute, but notice this declines tremendously. Perhaps that was sort of what was going on. Another reason that people have talked about it being lower now is that accounting doesn't capture as well what the value of a company is, because there's lots of intangible information that is not captured by accounting. So could be lots of things, but something that people have looked at. Notice what happens, generally you see this upward trend for earnings. So the higher your earnings, the more valuable your stock price is, and that has sort of increased over time in a general sense. So that could be, many reasons. Investors think that higher earnings companies are going to earn more for a longer period, or they're just more willing to pay for stocks that have high earnings. And so there are multiple reasons why we might expect that. But then also notice that it does line up with some key periods. So here, this big, huge dip is about the time of the internet bubble. Here is about the time of the financial crisis. We haven't quite got far enough, but right in here is the coronavirus pandemic. So lots of things that line up also with the value of stocks and their performance as well. So another thing we might be interested in is how well does financial information, so accounting information, capture the value of stocks? So we can look at that, and this is a new piece. So instead of doing tidy, I'm going to do glance, and glance, what it does when applied to a regression or something like that, it gives you summary information from the regression. So if I run this one down here that we'll look at in a little bit, it gives you the R-squared, adjusted R-squared, and then some other stuff from the regression. So we can use that. It's going to output the summary information as a data frame instead of the coefficients. So I can run this and I can get the summary information. So again, look up here and you see now it gives me for every regression, which is every year, the R-squared. So then I can, and other stuff as well. So I can plot that instead. And what do we get? Well, we get a general downward trend. So the stock price was explained quite issly in the early periods by this accounting information. When it went right up before the big bubble burst, it went down a lot. So this is sort of the idea that people stopped paying attention to accounting information and were valuing companies based on other things. And there's some evidence that it was irrational. Then we have something that sort of equalizes and then it crashes again, right? So it goes down, but overall sort of this downward trajectory. Well, some of the explanations for this are, again, there's stock prices are explained by other things other than accounting information more as we get later into the samples. So things that are not captured by accounting maybe matter for stock prices, either that or the stock prices are valued based on other things or incorrectly valued. So we have different reasons that could be the case, but people use these to try and understand sort of how what's happening with pricing in the stock market. And then we can do a couple of other things that we'll talk about in class, but some things that others have been kind of interested in are, is it the net income part that matters, or is it the book value part that matters? Because we have both of these in here. This has been called incremental R squared, meaning how much does the R squared increase when you add a new variable? So I'll show you how this works. So let's say we just started with net income, and we can pull out this R squared from this data frame that is created here. Remember, I showed you this creates a data frame, so we have R squared and all these other things. Well, we can treat that as a data frame and pull out this column. So remember, we use $sign to pull out of a data frame and then call the column R squared. So for net income, what we get for that R squared is 60% R squared if we just use net income. Okay, that sounds okay. Now we want to know, if we add in book value of equity, how much more does book value of equity help us? So we went from 50 or 59 or 60% R squared up to 67 or 68% R squared. So we increased it, but it's certainly not, it didn't go from 60% up to nearly 100%. It went up, an additional 7% or so. So adding one does not help us as much. So they both are capturing something that is similar. We could do the same thing, start with the book value of equity. Notice that's about 56%. So if we were just to choose one, we would choose net income. But they're fairly similar, 57% versus 60%. Then once we add the book value and net income, it goes up to 68%. So going from book value of equity, adding net income, increases about 11%. So that increase is bigger than if we were to start with net income and then move up adding book value of equity. Well, we can just calculate this incremental R squared. It's the same thing I just talked through. So the R squared, which is higher if you include both, minus the R squared for just using one. In this case, start with book value of equity and add net income. The increase is 11%. If we start with net income and add book value of equity, the increase is 7 or 8% if we round it. So the incremental benefit from including book value of equity is smaller than the incremental benefit from including net income. So there are lots of research papers and entire careers that people have built around doing this sort of analysis. Another one that happens that we will talk about is once we come up with this, right? So we could then think of this as the value that is explained by accounting information. Well, some people have created trading strategies that then say, let's trade based on the information that is not explained by accounting information. So this goes back to our return prediction stuff, and people use that in addition to other things we've already looked at. All right, in the homework, I'll introduce a couple of new things, and the main part will be separating these into different pieces. So let me just talk quickly about what that will mean. So book value of equity is equal to total assets minus total liabilities. So if we go in here back to the data set, this book value of equity number is equal to this total assets number minus the, oh, I didn't put in total liabilities. Well, it's total assets minus all of these liabilities here. So CL, DLTT, and ONCL. So if you were to take total assets minus these three, that would give you this book value of equity here. And so what we could do then is, instead of putting in just book value of equity, we could put in these others separately. So we wouldn't put in book value of equity, and we would put in total assets and all of the liabilities, or we could break them down into further pieces, use CA, PP&E, and ONCA. Those are all the pieces of total assets that we have in this data frame, and we could put in these three. So that would give us 6 different options here to put into the regression. Additionally, we could break down net income. So we have net income over here, and net income is just revenue minus all of these expenses here. So we could put in revenue and all of these as well. So we would have longer regressions when we get to this stuff, right? More variables, but they all add up to the same thing. So we should get something very similar. All right, so we'll have a little bit of fun with that.